view. Let's move on now and talk about HCL Tech. The company reported a steady quarter with earnings in line with estimates, so there were no negative surprises, which is a great thing. And the management delivered better than expected revenue growth guidance. Reema caught up with HCL Tech's MD and CEO, C. Vijayakumar, and the CFO, Prateek Aggarwal, began by asking them about the quarter gone by and how they see growth going ahead. Listen in.
The year started very well. Second half has been a little soft. And in spite, if you compare it to our expectations, the couple of verticals, tech and telecom, primarily in our engineering and R&D services, the revenues came lower. Maybe about $20 million came lower than what we expected in engineering and R&D services, and that was mostly attributed to the tech and telecom verticals. As we move forward, I do think most verticals have stabilized, but one thing I want to call out is based on the rigor of execution and the ramp-ups that we have done for some of the large deals that we won in financial services, we expect FY24 to be a very strong year for financial services. And in the mix of business that we have very, very negligible exposure to smaller banks. And we have a very good mix from banking, capital markets, and insurance. And insurance is a segment which is impacted by inflation, and we see significantly large outsourcing opportunities in this segment.
You said you have negligible exposure to the smaller banks. Can you tell us what percentage of your BFSI portfolio is exposed to the US regional bank and maybe even some of the troubled European banks?
Yeah, see, our revenue in BFSI is about 20, and last quarter was about 21%. And of that 21%, only 1%, less than 1% is exposed to smaller banks and the bank that you are referencing. And even within that, there is a run this business spend and the change. So it's really negligible.
So 1% of the overall BFSI portfolio or overall?
Overall BFSI portfolio.
Got that. Prateek, in the press conference, you all said that your aspiration is for 19 to 20% margins. Though for FY22, you have guided for a margin range of 18 to 19%. Can you tell us why you're not confident about achieving that aspiration range this year? Because the supply side situation is improving rapidly and your growth is also going to be fairly okay at 6 to 8%. What would be the margin headwinds to your mind, and take us through the guide path for achieving your margin guidance?
Sure. Thanks, Reema. That's a good question. So let me take a few minutes. I think, first of all, margin expectation and aspiration for the medium term continues to be fairly squarely in that 19 to 20% band. That is the number. 19.6% is what we achieved in FY19 and FY20. So that is what we definitely want to get back to. And like I said in the analyst call yesterday, it is not a question of whether, it is a question of when. Having said that, I think this year definitely has those tailwinds that you talked about in terms of the supply side easing a little bit. But then there is this volatility and uncertainty in the environment that we do need to factor in. And, given that, we've probably got a little used to growing at 14, 15, 7, 16% in a services business. From that perspective, 6.5 to 8.5, though it is good for the current times, doesn't give us the operating leverage that we really need to sort of keep on increasing margins. So all that has been factored into the guidance, and we expect to be within the guidance. And if things do turn out well on the environment, who knows? We could probably beat it as well. Who knows? Fingers crossed.
Okay. Point is taken. CVK, any project cancellations in Q4?
No, nothing to call out. It's normal things here and there. Some cancellations happen, but it's very small.
CVK, is there a risk that pricing will come under pressure in FY24 at some point in FY24? If all the clients or most clients are gearing and veering towards cost optimization deals, they are going to be trying to squeeze costs on all fronts, which also indicates the kind of money that they give to technology vendors. From an industry point of view, do you think pricing discounts may be something we will start seeing in FY24?
We've had one of the best renewals in the last year, right? Almost 99% plus revenue we renewed. Whichever was due for renewal, we renewed. And if you look at the whole IT spending, there are multiple elements. And when customers want to optimize the spend, there are still many other areas like software, the hardware, and there's in-source spend and outsource spend. Between the four categories, I think there are opportunities in every place. And the outsource spend, I think customers are looking at how can they get more for same or more for less kind of operating model. And they're looking at right shoring, they're looking at higher efficiency measures. And when we provide them those productivity benefits, we're also equally focused on how do we kind of drive that productivity. It does not impact our realization and our overall profitability. How can we constantly be after the automation programs which really delivers those cost savings for our customers? So at this point, there's going to be pressure for sure in this environment. Customers will expect when renewals are coming, they may have a higher expectations, but there's equally good technology toolkit that's improvising for us to help achieve those productivity targets.
So customers are asking for discounts.
Yes, when there is a renewal, obviously there is an expectation to look at higher productivity and higher efficiency. It's a part of the game.
So like to like last year, were there any pricing discounts?
No, last year, in fact, we were able to increase prices. Our billing enhancement program that we put in place delivered almost 115 million, which is 1% improvement in our margins was attributed to the billing rate increases that we had from our clients.
Got that. Prateek, your hiring target for next year is at 15,000, and this would compare with about 26,000 freshers that you hired in FY23. Can you tell us the reason for that? How much, bandwidth do you have on your existing bench? Is there scope to improve utilization? And do you think increasing productivity, tools like generative AI, may be one of the reasons why companies from here on will start lowering their hiring targets and requirements?
Right. So that's a number of questions. I'll try and make sure I answer each one of them. So Rima, there are those 3-4 factors which go into deciding the number of freshers that we want to hire next year. So automation, more and more automation, and the oncoming of the new AI tools like ChatGPT or Copilot or others like Bard, etc. There are other factors like number one, the gross hire requirement itself of the company is going to come down. There are two factors that basically drive that. Number one is the attrition. So you would have heard that our attrition in the March quarter this year was roughly about half of what it was in the June quarter last year. So compared to Q1 to Q4, there has been a sharp drop in the quarterly attrition. And therefore, the need for more people to be hired to replace that attrition backfill, as it is called, it comes down. The second thing is obviously we grew at 15.8% in our services business last year. And now for this year, the growth guidance is if you take the midpoint, say 7.5%, it is less than half of the 15.8%. So that also brings down the gross hiring requirement.
All right. Well, that was a commentary coming in from HCL Tech. And for starters, the stock is going to open up in the green with a gain of around 1.6% odd. It's 9:10, so let's